Welcome to Money Watch Weekly. Today with me, Yawela Chomba. Now, if you don't know, at the beginning of the year, scientists said that the Earth is spinning faster around its axis than ever before. Explains why, with just a blink of an eye, we are already at the end of March. Quarter 1 of 2021 comes to an end. Despite time moving so fast, though, a lot has happened economically at both micro and macro level here in Zambia. One of the major highlights has been a declining local currency and the runaway inflation. However, in today's Money Watch, we look at the quarter in review and also take a deep dive into the next quarter. Someone who is no stranger to your screens here at S24 is Mutsunge Zulu, Chief Macro Business Analyst at the Kwacha Bay Treasury. Mutsunge and I will discuss some of the highlights of quarter 1. Greetings, Mutsunge, and welcome to S24 and Money Watch.
Thank you.
Right. Now, Mutsunge, let's start with the easy picks, inflation. Started off, well, I would say it's on a runaway trend right now at 22.8 as of the latest print for March. Can you tell us more about where we're coming from, where we are, and what that means?
Okay. Thank you, Wela. So inflation has run away, yes, 22.8, 60 points jump in the month of March, and very worrisome. So this inflation is cost push, in fact. So it's actually stemming from a weakness in the currency. So currency has been on a losing streak. The kwacha has been depreciating continuously. And because of that, then there is speculation. There is that pricing into the markets. We are import oriented. So it means that inputs are expensive. And the easiest way for manufacturers to, pass on costs would be to just increase prices. And this is exactly what we are seeing. Then, so it pretty much started out as cost push inflationary, price of food ticking upwards, irrespective of whether maize prices were coming down. But if you look at a whole basket of goods, you'd find your cooking oil, they have to be produced. So we are looking at manufacturing. Yeah. So that value chain as well has actually taken and borne the brunt of a weak exchange rate. And you will also agree with me that everyone out there who's selling something will refer to the dollar, even when what they produce has nothing to do with the dollar. So it's an opportunity for people to speculate and hike prices. And then as we got to the end of the quarter, there is demand pull inflation kicking in. So demand pull inflation stems from the fact that when there's too much money chasing few goods, there's so much kwacha around. Yeah. I think this is part of efforts by the central bank earlier when there's the medium-term refinance program. There's also been that open market operations where they've been injecting liquidity into the system just to ensure that they absorb some of the COVID-related shocks. So because of that and unconfirmed, I think you've seen social media videos of people flaunting cash around, and for us economists and financial analysts, we get very worried because then when inflation starts ticking upwards, I'm not surprised because that's what the consequences are of flashing money around. How it got into the system, God knows. But anyway, that's demand pull. And if that is not curbed, it becomes very worrisome because if it's not managed, then 22.8 could be the lowest inflation that we're talking about this year, and it erodes values. So in a nutshell, every headache on the inflation front is actually coming from the currency.
Okay. And speaking of the currency, started off around 20 kwacha to a dollar in January. Now we are 22, just above 22 kwacha to a dollar. In fact, this morning, somebody did ask me to say, it's probably the question I get all the time. Are we expecting inflation to keep, the currency to keep weakening? And at what point do you think it will reach before it starts reversing some of its losses? But tell us more about the kwacha as well.
Okay. So the kwacha depreciation is a continuation of what we saw last year. I think last year the kwacha did take a beating of about 43%. Drivers of currency are not new to Zambia, especially being a net importing nation. But I think around the fourth quarter, the biggest drivers were petroleum. We have to pay for oil in dollars, which is understandable. But then there's agric inputs. The farmer input support program dictates that you have to provide inputs such as fertilizer and seeds. Let me dwell a bit on fertilizer. Yeah. So that fertilizer has to be imported coming from South Africa and from Kenya, and we need dollars for that. So you'd find that if we thought about manufacturing our own fertilizer, we would be solving one area and one problem, easing pressure on the currency. Then at the same time, pressures in any economy are there, especially on the FX market, which could be one, due to insufficient supply, or demand could actually be outweighing supply. If you read the central bank communique, it says exchange rate pressures are due to mismatches in the FX market, so demand and supply is not matched. So we've got more demand and less supply. Where's the demand coming from? This economy is trying to recover. At some point, our COVID cases went down and the economy was reopening. So a lot of us Zambians make one mistake. When we start to see depreciation, we think the economy is shrinking. For a net importer, no. When you have depreciation, it means that a lot of people want dollars. For what? For import purposes, because some of them could be producers. We get inputs from out of the country. People do business and they have to get their goods from China, from outside the country. So that's one area. The economy was trying to grow and to recover the lost growth in the full year of 2020. But then it also comes at a time when there are certain actions that the authorities had put in place. Because we were talking about debt, and that debt has to be serviced in dollars.
Correct.
It meant that the fiscal authorities were then looking for dollars. Then around mid-year of last year, there was that pronouncement that the mines would have to pay their taxes in dollars. So what that did was it solved one problem, dollar supply to the authorities, but it created another problem because you know what it did? It sucked out about 45 to 55% of dollars on the open market. Yeah. So the normal trades that you would see, the normal patterns that you knew, like on the 15 when those mid-month taxes and then the kwacha gets support, gone. The kwacha started to run away. And what we would go to as a buffer, which is your FX reserves. Any country has FX reserves, which any central bank whose mandate is price stability would have to sell some dollars on the open market and just cushion that pressure. It became costly to sell dollars on the open market because our reserves were at decade lows. Right now, Zambia is sitting at $1.2 billion, which is just shy of about maybe 2.3, 2.4 months of import cover. And Zambia is coming from a base where its import cover used to be 3 months. If you compare with its peers, the likes of Nigeria, we're talking about 6 months import cover. So it means that that buffer was gone. So the normal action which would have been taken by the central bank to stabilize the currency could not be taken because of disease pandemic.
Correct.
So usually when your currency is running away, the easiest remedy is to tighten rates, is to tighten monetary policy, to hike your statutory reserve. But hiking a statutory reserve would have meant sucking out money from the system, and then credit risks would then ensue.
Yeah, which brings me to the next question about the central bank. As you answer that, they have tried, you can tell by their behavior towards MPR, monetary policy rate. They went down to 8%, now it's gone back up as well. So you can tell the central bank is doing its best to address the situation that we're in. But how different is the current situation of weak currency, high inflation? How different is this situation to times ago when we had similar situations? The Bank of Zambia trying its best, but how different is now against maybe 10 years ago?
So how different it is from 10 years ago is that there's debt, which is the elephant in the room. We didn't have that much debt 10 years ago, and we didn't have that much pressure to service our debt. We didn't have capital market debt, such as Euro bond debt, you know, where people are demanding and they want you to pay. We did have debt, but that was negotiable debt with other countries, where you would get into bilateral agreements, and then it's very easy to negotiate with countries and say, look, we are pressed and would like to defer. But this time, you have capitalists holding your debt, and capitalists don't defer. So yes, the central bank can be given a pat on the back for trying their level best. So it takes us to a discussion around fiscal and monetary policy. We all know that the fiscal position for Zambia is frail, it's feeble. We've had balance sheet vulnerabilities, hence discussions and talks with the IMF for bailout. So at some point, the central bank runs out of ideas because on one end, there's little they can do. There's only much they can do. Yeah. I mean, even this decision to not offload reserves on the market to cause stability, I mean, it's them putting their foot down, because if they did that, I don't think we would last that long. We would end up depleting reserves, and then we would be naked, unhedged, exposed to external shocks. Yeah. So, like any other central bank in COVID period, I think we've seen exceptional decisions that may not make sense to the current economic or the economics that we have learned from academics, where in certain periods, where you're supposed to be hiking rates, everybody was going for monetary policy easing.
Yeah.
I think you did see the US went on stimulus package program. This is where now your central banks and your fiscal sides, which is your Ministry of Finance, have to come and put their heads together to think about the effects of that shock. Then they cut rates to record lows, 8%, unheard of in the history of Zambia. The first time the BPR started was in 2012, and the first BPR rate was 9%, but this time 8%. Then, you see, there's one thing about cutting rates. When you cut rates, you make credit affordable. So because you make credit affordable, indirectly, you give people disposable income. So if I was supposed to pay X on my loan, I'm not going to pay as much. Okay, so because of that, I have more disposable income. It then spurs that level of demand. And when demand starts to spur, it starts to precipitate inflation. That's why central banking is like driving a manual car and you're climbing uphill. You have to keep on clutching. So, managing an economy is full of clutching. So the question is, would you like to forgo inflation and focus on other things? But right now, you and I know that what we are facing is currency related. So come MPC, February 17th, that announcement, everybody was waiting to hear what the central bank was going to say. Look, on the face of it, it looked like they were going to hike rates or just leave them where they are. Yeah. 50 basis points is as good as nothing given the current situation. And that's why you saw that even after hiking rates 50 basis points to 8.5%, not much effect on the currency. It's continued to run away. But because of COVID was the biggest showstopper. Because of COVID, they thought about how small businesses are ailing. They thought about how people have lost jobs. They thought about how increasing that would increase your obligation in paying your debts, your loans. And one thing I can tell you is the rate hiking cycle has begun. How it's going to be done, definitely in piecemeal, but it will be determined by how COVID is managed. Yeah. So the more COVID cases you see coming down and we're getting comfortable and COVID has been managed, it will give more leverage to the central bank to continually hike rates. Because like I said, hiking rates tightens monetary policy, and you know what that does? It starts to arrest your currency. But until that happens, we can only look for a source to supply dollars onto the market. We need more dollars. And part of the reason why we haven't seen that many dollars flowing into Zambia is because of FDI. FDI has actually slowed. Yeah. You know why? Sentiment has dwindled. Why? Because we have a hat trick of coupon defaults on Eurobonds across all of them now. It's 2022, 2024, and 2027. Yeah.
Sorry, I'll stop you there because I want us to quickly go to government securities. I mean, when we said the year, the bonds and treasury bill auctions were not very well subscribed, but now you've seen a rise in subscription. But of course, the shorter dated securities have become unattractive. I understand the central bank has a buyback program. Tell us more about that.
Okay, so thanks for that question, Noella. So usually, and this is another theme that has spilt over from last year. Yeah. We've been talking about this risk theme, where people are more poised to the shorter end of the curve because of managing duration risks. People would rather take shorter dated risk, higher yielding, than go and lock up their liquidity in bonds. Bonds are above 1 year because there's uncertainty. One, there's country risk. This is an election year, political uncertainty. Secondly, Zambia's sovereign posture, we are default rated. So debt restructure, people are not so sure. Investors are not so sure. They're asking themselves, should we invest in Zambia? Or maybe should we go to other jurisdictions and come back to Zambia when they get their house in order? Yes. So then what we've seen is treasury bills outperforming the bonds. Why? They are more shorter dated. The most attractive point on the treasury bill curve is the 1 year. Right now paying you 25.75%, which is about 295 basis points above current inflation. So then something started to happen. Because your inflation is ticking upwards, it's now throwing your curve underwater. What do I mean? If you go for the 3-month, the 6-month, and the 9-month, the yields are all below inflation. Who makes an investment that is below inflation? That's the unattractive nature that we're talking about. That is why if you look at the performance of the auctions, if you go to the 1 year, everybody is rushing to the 1 year because where on earth are you going to get 25.75% if you lock up your money in 1 year? That is why even people outside, those countries that are dealing with negative interest rates, would definitely want to flock and lock up their liquidity in Zambia. But of course, the showstopper would be one, the currency, and then uncertainty. But then if we look at the bonds, the three auctions that have taken place this quarter of the year, the third one was the one that was better of the three in terms of subscription. The central bank was able to raise about just shy of 1.5 yards, almost just there, meniscus. The rest here, 400, 450 out of 1.5 billion of assets on offer. Why is this? What we started noticing is a pattern. First of all, we can understand that the reason why people would never lock up their liquidity in these bonds was because of duration risk, uncertainty, political risk factors, sovereign risk factors. But then this improvement, the sudden improvement, is actually spurred by an asset buyback program where the central bank is also trying to restructure domestic debt. So right now what you have is, why would they be restructuring domestic debt? You're sitting on arrears of about, the last announcement was 26.5 billion kwacha. Yeah. This represents monies that the private sector are owed, your SMEs, people that have done works for the government, people that are your suppliers, contractors, and retirees, for example. So this program is dismantling arrears. So they're using bonds and bills to pay people that they owe money, which is a good thing, Yowela. But I have a problem with that. It's actually shifting a fiscal problem to the monetary side. You know why? Because when you pay someone bonds and bills, it's a good thing. You've given me kwacha, you owed me money. Guess what? We're a net importer. I'm actually going to join the queue for dollars. And that's why that backlog is widening. And that's another driver of dollar demand. So dismantling arrears, yes, shifts the problem from the fiscal to the monetary side. It's a good thing because you're empowering people, you're giving them liquidity, which they need. But these same people are not getting those inputs from Zambia. So it's an opportunity as well for us to ramp up and say, how can we start to provide inputs locally? So you see that the markets themselves are telling us something. Then on one end, I thought would be temporal, but it looks like this program will go on for a longer time because they're determined to dismantle arrears. You dismantle arrears, you give people cash, you pay them, those people will then, ripple effect, multiplier effect into the system, and then this economy is supposed to grow because you know that Zambia has a target of 1.8% this year, though there are headwinds here and there like your currency and everything. So accessibility of currency, very important because it makes the ease of doing business, Yeah. So then that's about it. So if we look at, according to the prospectus, the central bank had 8 treasury bill auctions, 8 or 9, and 3 bond auctions. If you go with the prospectus, things that the market can see with their eyes, they were able to raise 10.9 billion out of a target of 12.3. It would be premature to say they're running a deficit because they are off-market auctions, which the market doesn't see, which is the preserve of the central bank. Yeah. And I strongly feel that they are well ahead of target of whatever they wanted to achieve. But in that analysis on the open market, you would actually see that the treasury bills again have actually outwitted the bonds because they were able to collect or to raise more money on the shorter end than on the longer end. But we're getting into the second quarter. So the focus would be, should this bond buyback program continue, then it means that assets will continue to be attractive. And what makes them attractive, Yowela, is, you see, there's an inverse proportional relationship between yields and the price. When your yields are falling, it means your price is going up. So because there is demand for assets, what's happening to their price? It's going up. And when the price goes up, it means the yields are going down. So this then puts pressure. And these prices are in the secondary market. And because the prices in the secondary market, the yields in the secondary market are coming down, meaning the prices are going up, it should put pressure on the primary market. So we should see the curve start to fall. A falling curve is good. You know why it's good? Because it means that interest rates for term funding would actually start coming down. But there's one showstopper, the exchange rate.
Right, I'll hold you right there. Let's quickly go to commodities: copper, gold, and crude on the world market. Over the quarter, we've seen these three. I'll pick on these three, but of course we have other commodities that have been showing positive growth.
Okay.
These three have shown positive growth over the past 3 months. With copper, people will be asking, why haven't we felt the benefits of copper prices going all the way up to about $8,000? Gold, why not getting involved in gold? Crude, we've not yet started feeling the negative impact of ERB changing those pump prices, which is good, but what should we expect? What happened in this quarter over those three commodities quickly? But also the gold, I know that Bank of Zambia also went into a purchasing agreement with the ZTCMIH and the mine. So, but just tell us more about how the commodities have performed this quarter.
Thanks, Joel. I'm going to tell you a little story, a short story about what is cutting across all these commodities that you've spoken about. It's pandemic, it's COVID. So on one end, economy is excited that there's vaccine rollout programs. So if you talk about a vaccine rollout program in the US, in Europe, and anywhere else in the world, what that then prices into the market is that recovery is coming, okay? And then you've got a China that has already exterminated effects of COVID. I don't think you've ever heard of cases for China. And it grew in January, February, put together 35% industrial output. Demand for base metals has actually gone up. China consumes 40% of the world's copper. So that's actually a good thing. And as we're getting into Q2, it's the peak season when it comes to production for China. And then you've got an infrastructure bill. You had elections in the US. Everybody's waiting for Joe Biden's infrastructure bill. An infrastructure bill means more copper needed, more steel and everything. So everything is leaning towards supporting demand for copper. You've got a greenfield project. We're talking about the electric car era. Everyone is looking at a sustainable economy. An average car needs about 20 kilograms of copper. So you can see that there's a lot of things that are supporting copper. Trafigura has given a forecast expecting that in the next decade, copper should hit $15,000 a metric ton. When I read that, Joella, I thought we would have to be very naive to miss out on that boom, And then coming back home, what has happened? Why aren't we feeling the benefits of that? We don't own the mines, Joella. We can only benefit to the extent that in terms of collecting taxes, we'll collect more and everything. But you remember, there's one thing, Joella, if you don't own the mines are not obliged to bring their dollars to Zambia. We don't have a regulation that forces them to bring their dollars to Zambia. So what are we doing? If you look at the economic recovery plan, there's a tone that the authorities did set out. I think a few weeks after the ERP, you did see the president fly to the copper belt and he quoted the key mines. He was at Lubambe. Why Lubambe? Lubambe has a big project, Joella, that could be a game changer for Zambia. 1 billion project in terms of what they want to do, the next level. Trust me, if those kick in, if the Kansanshi copper sulfate program kicks in, I think DRC will be chasing behind Zambia. And Zambia, you could see the production in 2020. We're talking 868,000 metric tons. I wouldn't want to get so excited, Joella, not that I'm a pessimistic guy, but that we would have already hit 1 million metric tons had it not been for the mining squabbles, the KCM, legal back and forth here and there. But we know that is being addressed. We understand there is this business reorganization that's taking place, the Mopani deal and everything. The key question there is, what will it take for us to start actualizing, to get Mopani to be pushing 150,000 metric tons? Mopani needs about $300 million of injection. And for KCM as well, it's Zambia's biggest mine, So these are some of the things that are happening in the sector. So you can imagine that the next stage for Mopani is to find a strategic partner. And the minister was very clear to say stage 2, equity partner. The best thing that Zambia has done is to sort out that privatization mistake that was made 25 years ago. Joella, there is nothing as good as being a majority shareholder because you get to dictate where the money does go. So if that is done in an acceptable fashion, I expect that those dollars, and assuming we start producing
the copper.
Yes. It means all those dollars will come into Zambia. It means the economy of the copper belt will tick up. you know, when I talk about mining, I'm so passionate about mining. It's just not about digging the metals from the ground and exporting. I'm talking about downstream business. Look at the value chain. Those who supply gloves, sulfuric acid, ammonium nitrate for explosives, everything, Yoela. It just changes the employment, you know. So that's about copper. Then for crude, crude has been a seesaw. So crude, if you were to plot a pattern of COVID cases shooting up versus crude prices coming down, you would see that there's a relationship. So whenever cases start spiking, it means that there could be potential lockdowns. And those lockdowns that you saw in Europe, in a bit in Africa, and in the US, all those were meaning that demand for petroleum products will go down. And then Jerome Powell issues a statement and says they only see crude demand coming back by 2023. It was worrisome. But then there's the OPEC Plus member states, that club for oil producers that have been supporting crude for the longest of time. What do? They play around with supply. They manage their supply, and because of supply, then they keep the price at a certain level. Do you know that crude did hit $70 a barrel 3 weeks ago, and then it started to fall? And then you had that Suez Canal issue where, I mean, that big vessel just goes and, you know, closes that gap. Whoever thought that one ship, one vessel, could actually bring the world to a standstill, bleeding 6 to 10 billion in terms of trade. So you can actually see that we've learned supply disruption. And what supply disruption means, it was COVID at first, next it was the ship. And when that thing blocked that thing, there were 24 oil tankers, Yoela. Now everyone was worried, how is that oil going to reach their destinations? You know, so all that. So crude has been a seesaw. Not very good news for Zambia when crude is ticking up to those levels, because that coupled with our currency is a nightmare for manufacturing powers, because if I look at our PMIs, one of the reasons is that energy prices have been high. But then, while there's been a delay, let me deviate a little bit. Yeah. Even the IMF picked it in their press release, where they said, we acknowledge that certain price hikes that were supposed to be effected could not be effected because the authorities were thinking about people. They were thinking about you and me. They were thinking about the economy. Say, if we hike fuel, then it means inflation will just run away, you know. It means that manufacturing and operating costs will then go up. There is something that the revenue authorities, in conjunction with the ERB, did, where they, is it zeroized or they scrapped out the VAT? Correct. Yes, Yoela, I would like to dwell a little bit on that. So what they did was, you strike 16.5% in terms of petroleum, right? So it means that people get the benefit of just a cushion. It's temporary, but what it does is it does increase the cost on the private sector. What it means is that those people that were buying petroleum and were claiming VAT and were using the proceeds of VAT to be able to pump back into their business, they won't be able to do that. There's nothing to claim. So it's one problem solved on one end, another one solved on the other. It's not anyone's fault, but what I want to bring out is there's been more action that has been focused on easing the effects on the average Zambian than for a business. I mean, it's like if you ask the authorities, would they be more concerned about easing pressure on a corporate entity or on the individual? They'll think about the citizenry, because now we're talking about cost of living. You and I know that the JCTR food basket is now is 8,500, and yes, and it's also believed that, look, it's at a time when the private sector and the public sector are supposed to come together. Look, it's private sector that drives growth. So this is a time when the two put their heads together and discuss. You know, it's like what's happening. If you look at the economic recovery plan, you know, the mines, I attended one function where the mines said, we are happy to help with Zambia's V-shaped recovery, but we are only asking for 3 things. One, we're not interested in the Bank of Zambia refinance, that targeted thing. The mines don't borrow from Bank of Zambia or banks. I mean, they have other credit lines out there. Yeah. They said, just give us a stable VAT regime. I think that's why you saw that VAT that was paid to them real quick. Yeah. Give us stable mining policies and help us on the double taxation issue, where we are taxed on production and at profits, mineral royalties. They said, if you can just do these 3 things,
Well, good.
you'll see our dollars
Yeah,
will help.
as we're winding up, Mutsonge, quickly, the IMF, we're now talking to them again, virtual discussions. We just had some last month. There's more that started now. So quickly, just tell us more about where we are with the IMF, and then I'll ask you the second question to just wind up. Tell us your forecast for Q2 in about 5 minutes.
All right. So one, yes, the IMF will start virtual talks with them. In fact, on the 30th, which is today, and they will run for a fortnight, which is 2 weeks. This is a continuation on that Davison Robinson's team that came and they went back and said they will go and deliberate and come up with what technical intervention would be most suitable for Zambia. And Zambia has been in talks with the IMF. Just a little trip down memory lane. I think the first time they ever engaged the IMF did request that they appoint a financial advisor. That's where Lazard is coming from, in case people are wondering.
Yeah.
Yes, that was an IMF outcome, to say go find a debt advisor and then start to restructure your debt and everything, and that is actually going on. And if people think that Lazard is not working, in fact, it's Lazard that has managed to keep these creditors at bay. Yeah. So you've got that. Is it a good thing that the IMF have come for the second time? Yes, it's a good thing, because if someone didn't want to give you a listening ear, they wouldn't even be wasting their time. So it's a good thing. It's going to be an air of confidence. Even as this thing is happening, it's giving confidence to investors. It's giving confidence to whoever wants to do business in Zambia. Something is happening. It's just that the timing is what is not certain. We're getting into an election year. Under 4 months, we'll be getting into an election year, and very highly unlikely that a package could come out just before elections. But obviously after elections, many analysts have actually predicted that Zambia will get a package immediately after the August vote. But it's definitely going to come with conditions, because I think we're in a very dire situation. Inflation is running away. We don't have dollars. We've got dollar scarcity and all that. We need balance of payment support like yesterday. So yeah. So I think Zambia is doing well on that front. But I would like to reiterate that if these discussions had actually started 3 years ago, maybe we would have actually finished the first packet. So because of that, it then improves pricing of debt in the international secondary market, usually after the deal has been signed, because it gives that air of confidence. Yeah. Yes. And then
Q2?
Q2 focus, not very different from what we saw in Q1, but I'm just glad to see that COVID cases have actually subsided. Positivity cases are low. I think the last positivity case I saw was about 4.5%, which is a steep improvement for Zambia. And mortality has actually also pretty much reduced. But then what I see is that inflation will continue for as long as currency route continues, which we've continued to see the currency route. So I still expect that inflation will still be on the uptick, given that I don't see anything that the central bank has done in terms of curbing that currency slide. It's still there. So in terms of that, I expect that private sector pulse will continue to be in contraction. Yeah. I think the biggest game changer will be what comes out of discussions with the IMF. That's number one. Or if something happens probably on the mining front, that would then boost Zambia's confidence. So I should say these headwinds will continue. The interest rate hike cycle will continue, but at a very infinite small pace. Yeah. So if we're talking hiking rates, maybe another 25 or 50 basis points. And it's one of those things where you say, let's try 50 and see how far it's going to go. If we don't get the desired results, maybe 75 basis points like that. But it's an election year, Yoela. Most of the things that are going to happen in Q2 would definitely be also linked politically to some of the promises that were given. If you read the ERP, there are things that were promised in Q1 and there are things that were promised in Q2. So we expect one, cost of service study, IPP tariffs, that's independent power producer tariffs. We expect to get that in Q2. There will definitely be commissioning of projects. The lower curfew with the 750 megawatts, everybody's itching and thinking, when is it coming on board? So there will be all those things from a manufacturing perspective. And if those do kick in. And then lastly, I just want to say, because of that precipitation, and we expect bumper harvest, I think, across for wheat, for a lot of things, and some of them will start coming in the second quarter as we step in. So I would say cautious optimism. We are well positioned. You know, a lot of fundamentals are in our favor. It's how we tap those opportunities and look at copper. I look at a number of things that I've spoken about, and yes. So it's how we navigate this, and it will really, really need everybody to rally behind. I mean, this is not this is not a government problem. This is everyone's problem, and I think we all need to do our part. So I think that would be my Q2 focus for Zambia.
Right. Mutsunge, always a pleasure having you on Money Watch. I know there's a lot that we are here to discuss because you can't squeeze everything in such a short period of time, but I think you've covered 90% of quarter one. Right. So that was Mutsunge Zulu, Chief Macro Business Analyst at the Kwacha Bay Treasure, a unit of the Business Telegraph, giving us a preview of next quarter after going through what has transpired in the last quarter of 2021. And I think I've got nothing much to say because I think he's closed the remarks. He's given us closing remarks by telling us his expectations for Q2. But I think key is the authorities just need to navigate the opportunities that we have ahead of us, IMF as well as the ERP. But otherwise, that's all we had for you in this week's Money Watch Weekly here on S24. Thank you for joining us. See you next week.